Okay. So good evening, good afternoon, and good morning, everyone, and welcome. My name is Takuro Kimura, representative of the Japan Impact Investing Network, or J-IIN. And thank you very much for joining us today from around the world. And before I enter the substance, let me clarify a few logistics points. The first one is timetable. After we start the session, the presentations will follow until 6:30 or 40. Then followed by a panel discussion before we answer the questions we had received at the registration and those we will receive during the session. Secondly, about the recording. We will record the session and the recording will be shared with those who so desire. And only the presentation part of the session will be shared. And finally, when you leave the webinar today, you will be prompted with questions. 2 questions only. So I would appreciate it if you could answer those questions to help us better organize our future webinars. So now let me get back to the substance. Again, good evening, good afternoon, good morning, wherever you may be. So we established the J in 2019 to advocate that impact investing is not philanthropy, and rather it is an investment that seeks to generate both risk-adjusted financial returns and positive impact. And over the years, our discussions have evolved, and we have increasingly focused on what I would call the foundational impact, nature and biodiversity, without which it is difficult to imagine building resilient societies or sustainable businesses or economies over the long term. And nature and biodiversity represent an extraordinarily broad field. The solutions require effective public policy, entrepreneurial innovation, scientific and technological progress, active participation by local stakeholders, and the engagement and commitment of the private sector. The opportunities and challenges also span multiple sectors, geographies, and ecosystems. The challenge is also becoming increasingly urgent because monitored wildlife populations have declined by more than 70% over the past 50 years. This direction is deeply concerning because 50 years is just the blink of an eye for nature. And turning to the funding challenge, various estimates suggest that more than $1 trillion per year is needed to halt and reverse nature loss and biodiversity decline. Well, this is a small amount of money as compared to $130 trillion of asset under management by institutional investors globally. But only a very small fraction of this capital currently flows into nature and biodiversity. So this raises a straightforward but important question. How can we increase the flow of capital into nature and biodiversity? And we believe that institutional investors must play an increasingly important role. Philanthropy, public funding, and catalytic capital remains important, but alone cannot close the funding gap. And ultimately, nature and biodiversity must become investable at scale and capable of attracting risk-adjusted commercial capital. Well, that is the reason over the past several years, J-IIN has organized a series of webinars exploring natural capital concept, biodiversity credits, blended finance, technologies, corporate leadership, measurement, valuation, and other emerging topics. Today's session addresses perhaps the most direct question of all. How do we increase nature finance in practice? In other words, how do we move from just interest to investment? There is a strong response and a large number of thoughtful questions we have received from you suggest that interest is indeed moving beyond just awareness and toward implementation. I suspect that many of us are here because we recognize the urgency of the challenges and the need for practical solutions. I hope today's discussion help us identify practical pathways, and most importantly, I hope it encourages all of us to think about how nature and biodiversity can become a larger and more attractive destination for investment capital with sustainable financial returns. We are very fortunate to be joined today by an outstanding group of panelists representing different parts of the investment value chain: capital providers, project developers, capital users, and financial enablers. So with that, it is my great pleasure to hand over to our co-host, Mr. Jean-Marc Champagne, Managing Director of Seneca Impact Advisors, who will introduce today's panelists and lead us into the discussion. Jean-Marc brings extensive experience from a distinguished career in investment banking and advisory, and in recent years has focused on helping structure and mobilize capital for nature, climate, and sustainable development initiatives. His work sits precisely at the intersection of finance and implementation, making him an ideal person to guide today's discussion. So, Jean-Marc, over to you.
Thank you very much, Kimura-san, for the introduction, and thank you, J-IIN, for hosting this discussion, and thank you to everyone for joining us today. So we're joined by an excellent panel. I'll introduce them as we go into the topic, but as a quick one, Tom Holland from Vanna, Will McGoldrick from the Nature Conservancy, and Max Thomas from HSBC. So I'll just start with my presentation, and let me just bring this up. Give me 1 second to share this. Okay, I hope it's in full screen mode. Okay, so yeah, I want to use this opening presentation really to frame the practical challenge of nature finance. How do we move from interest and ambition to capital actually being deployed into real projects? My focus today is not to promote one mechanism over another. It's to look at how different financial structures solve different financing problems and how those structures need to be grounded in project realities. There's capital available for nature positive investment, but the capital does not move just because impact is important. And that's really clear to understand. And we find that there's a missing piece on both sides between the people developing projects on the ground and the financiers. It moves, though, when projects are prepared. Capital will move and risks are understood. Payment logic is credible. Local implementation is realistic, and the structure fits both investor requirements and ground realities. So the question is not simply, what instrument should we use? The better question is, what financing problem are we trying to solve and what structure fits this project reality? Okay, my slides are not moving. Okay, there we go. So the market has moved. A few years ago, much of the discussion was about why nature matters. Today, that awareness is much broader. Nature, biodiversity, resilience, and ecosystem services are now part of the mainstream sustainable finance discussions. We see interest from governments, development finance institutions, banks, corporations, insurers, philanthropies, and investors. But greater interest does not automatically mean greater deployment, and that's quite key. The nature finance market is still early, and that really needs to be understood. There are many mechanisms being discussed. For example, blended finance, payments for ecosystem services, outcome-based finance, biodiversity credits, insurance, green and blue bonds, and landscape finance, just to name some. But available capital does not automatically reach projects. And it needs to come in a form that fits their stage, risk profile, revenue model, and implementation reality. The challenge is no longer only awareness, it's execution. And that's constantly what we're finding and what we see on the ground. It's the execution that is the biggest challenge. Can we turn nature positive ambition into projects and portfolios that are investable, locally, grounded, and capable of being implemented? That's where structuring matters. When people talk about nature finance, the conversation often turns to the financing gap. And we just heard a little bit about that. And of course, the needs are large. But I think that the practical issue is simply not that capital does not exist. There's capital in the market, and it's looking for sustainable, climate-aligned, impact-oriented opportunities. The harder issue, though, is the fit. Nature projects often do not fit neatly into the way capital is designed to move. A project may have strong environmental value, but no clear revenue model. And we constantly see that all the time, or there may be a revenue model, but it's not quite good enough. So it may have community support, but no legal or governance structure that investors can finance, for example. It may have long-term impact, but the need for patient capital for preparation before it can absorb investment. It may be locally credible, but too small for a bank, development finance institution, or institutional investor to finance efficiently. And that is one of the biggest problems that we find all the time, is that these projects just are not sizable enough for what the requirements are for banks. So as I said, we're seeing this all the time in practice, but example in our work, for example, we support the Ministry of the Environment in Japan on international collaboration in Southeast Asia. The challenge is not simply identifying good nature ideas. The harder work is understanding which activities become financeable, which need grant or which need public support, which require local capacity building, and which may need to be grouped into a broader landscape approach. So the issue is not really, as simply as one could say, a shortage of capital, because I've heard that quite a bit, but that's not really the issue. It's the gap between what projects need and what the capital requires. So that's why, I like to use the phrase, it's a capital fit. So that's what's really, that's what we need. So nature finance will scale when the right type of investment or right type of capital is matched to the project at the right stage through the right structure. So structures, they must translate to capital on the ground, right? So this is one of the most important points. A financing structure has to work for both sides, right? Capital providers need clarity. They need to understand risk, repayment, governance, reporting, legal structure, and scale. Increasingly, they also need to understand whether a project aligns with relevant taxonomies, eligibility criteria, or investment mandates. That could include climate, biodiversity, sustainability, or green finance frameworks. Taxonomy alignment, though, does not make a project investable by itself, but it helps define what the project is and what it contributes to, and whether it fits the requirements of a funder, bank, investor, or public institution. But projects also have realities. Land and resource rights may be complex. Local organizations may have limited capacity. Livelihoods may be seasonal. Trust may take time. Implementation may depend on relationships and institutions that do not show up neatly in a financial model. So good structuring is not just financial engineering, it's translation. It translates between the capital needs and what the project can actually deliver. If the structure only works in a spreadsheet, it'll fail. So if the project is locally strong, but cannot meet basic financing requirements, it may also fail to attract capital. So the goal is to bring those two worlds closer together. The first financing need is often not investment capital. It's project preparation. And this is constantly what I'm telling people all the time on the ground and not to put a plug in for ourselves, but why we need to get paid, for example, to do this project preparation work, because there's so many times where the projects just aren't ready and they need that to get there. So many nature projects do not fail at the investment committee, right? They fail before they ever get there because no one has funded the work needed to make them investable. That work includes landscape scoping, feasibility, community engagement, legal structuring, partner selection, financial modeling, impact design, taxonomy, um, eligibility mapping, and funder alignment. This is not glamorous, but it's absolutely essential work that needs to get done. And this is the stuff that seems to have the hardest time getting funded. So a mangrove project, for example, a watershed project or an agroforestry project or a community enterprise does not become financeable just because the impact is strong. That needs to be clear, right? Someone has to define the business or the funding logic. Someone has to clarify who owns what, manages what, who benefits, who pays, and who carries the risk. Someone has to test whether the project can actually be implemented. Someone has to someone has to map the project against relevant funder requirements, investment mandates, and taxonomies so that capital providers can understand where the project fits. This preparation phase is often where the real value is created. For example, if in a project origination work linked to a major development bank, focus has been on systemically identifying, preparing, and structuring high-quality, investable, nature-based solutions across the Asia Pacific. That kind of origination function exists because good projects do not simply appear fully formed. They need to be prepared. If we underfund project preparation, we should not be surprised when the investable pipeline remains weak and continues to remain weak. And that's what we continue to see. So we really shouldn't be surprised at that because that's really the crux of the problem is the underfunding. So structures solve problems, but demand matters. Only when we understand the financing problem, then we can choose the structure. And we see that a lot, right? So the financing goes before a lot of times the actual or the structure goes before we understand the actual problem. So before choosing any structure, we need to ask one basic question: who pays and why? The payer may be a customer, a corporate buyer, a water user, a government, a donor, a development finance institution, an insurer, or a credit buyer. The payment may be commercial revenue, public funding, outcome-based funding, avoided loss value, procurement linked to sustainable supply chains, or a mandate to support climate or nature outcomes. But there needs to be credible demand. Finance follows credible demand, not just positive impact. Blended finance is useful when there is a credible project, but the risk-return profile does not yet work for commercial capital. Payments for ecosystem services can work where there is a clear ecosystem service, a clear beneficiary, and a credible payment obligation. Outcome-based finance can work where the project may not generate commercial profit, but can deliver measurable outcomes that someone is willing to pay for. Insurance can help where nature reduces risk, but residual risk remains. Aggregation can help smaller projects into larger pooled risk landscape portfolios. And for some landscapes, long-term stewardship structures such as conservation trusts, public private facilities, or project finance for permanence may be more relevant. The important point, though, is really that none of these structures is automatically good or bad. They are useful if they only solve an actual problem. So a credit does not solve weak implementation capacity. A bond does not make a project ready. And a blended finance should not be used to make a weak project look investable. And that's something we see quite a bit of. The structure has to be matched to the real constraint is really what we're trying to solve here and what we're trying to do. So interestingly, and a point I want to kind of focus on is insurance. Insurance is a very underplayed mechanism or financial pathway. So if we spend a bit more time on insurance, because really it's more interesting and it's one of the areas in nature finance that I think we can really take advantage of. So the point is not simply that insurance can pay after something is damaged, and that's typically what people think of. The more interesting point is that nature itself can function as a as a risk-reducing structure. So reefs, for example, can reduce wave energy. Mangroves and wetlands can reduce flood risks. Forests can support Forests can support slope stability, water regulation, and soil retention. Urban green systems can reduce heat and absorb storm water. So if we treat these natural systems as infrastructure, the value is not only ecological, there is also economic value from avoided losses. That could include avoided storm damage, avoided flood losses, lower water treatment costs, reduced infrastructure repair costs, reduced business interruption, reduced agricultural volatility, and lower public disaster response costs. So the changes, this really changes the conversation in terms of financing and how that works. So the conversation now becomes who benefits from those avoided losses, and can that value support the financing or maintenance of the natural asset? But nature doesn't eliminate the risk. That needs to be understood. It reduces risk, right? So the means insurance can still play, it really means that insurance can still play an important role by covering the residual risk that remains. So in that sense, insurance can still sit alongside the natural asset. Nature reduces expected losses. Insurance transfers part of the remaining risk. And if a shock the payout can support rapid repair, restoration, or continuity, if there's a shock that happens. So if there was if there is, or if there were parametric insurance, that can be especially relevant into what we're talking about. So a payout can be triggered by a predefined event or threshold, such as wind speed, rainfall, wave height, or another measurable parameter, for example. That can make funding faster and more predictable than a traditional loss assessment. But the design questions are important. So what is actually being reduced by nature? Who benefits from the avoided loss? Who has the insurable interest? Who pays the premium? Who receives the payout? Who is responsible for restoration? And how do we make sure the payout actually protects or restores the natural asset? So I would not treat really insurance as a standalone product or financing pathway, but I would treat it as part of a broader resilience architecture. So the goal here is it's not just compensation. The goal is to protect ecological, social, and financial value over time. So the second area I think we also need to look at, and I would like to highlight, is aggregation. And this is something more and more that I think is really important, because there's, many nature-based projects are just, they come out and they're too small, too local, or too fragmented to finance one by one. A single mangrove site, an agroforestry project, watershed intervention, or community enterprise may be valuable, but it may not justify the transaction costs for larger funders or investors. Aggregation can help by bringing multiple related projects within a landscape or seascape into a coordinated portfolio. This can create larger ticket sizes, but just as importantly, it can pool risk. So instead of depending on one site, one crop, one community enterprise, one revenue stream, or one implementation partner, a landscape portfolio can spread risk across multiple interventions. So that can make the overall financing proposition more resilient. It can also allow projects to share monitoring, reporting, governance, and community engagement and technical support systems. But aggregation should not just be financial bundling. It needs to make ecological and implementation sense, of course. And I think anyone in the NGO world or who's been on the ground would fully understand that. The project should reinforce each other, the landscapes, and they need to connect to real landscape functions such as water security, coastal resilience, sustainable agriculture, or biodiversity protection, or community livelihoods. If aggregation is designed to create a bigger ticket size, for example, if it's only designed for that, it may look better to investors, but it may not work on the ground. So the goal is not just to make small projects look bigger, and that needs to be emphasized, but the goal is to create a coherent landscape investment approach that is financeable, implementable, locally relevant, and resilient, because risk is pooled across the portfolio. So I want to come back to the main point here and just say that nature finance will not scale through more instruments alone. There's capital available, but capital needs the right structure, risk allocation, payment logic, and implementation pathway before it can move into real projects. Nature finance will scale when financing structures are built around real project conditions, such as what communities, implementers need on the ground, what investors require to deploy capital, and what the landscape can actually support. So that means preparing projects properly. It means clarifying who pays, why they pay, and whether the payment logic is commercial, public, outcome-based, procurement-linked supply chains, or tied to avoided losses, for example, in the insurance, what we just spoke about. It means reducing risk where appropriate. It means treating nature as infrastructure where it reduces physical risk, and protecting natural assets through insurance and risk transfer where residual risk remains. It means pooling risk and aggregating smaller projects into landscape portfolios where that makes ecological implementation sense. And in some cases, it means long-term stewardship through public, private, philanthropic, and sovereign-linked structures. But throughout all of this, the structure has to be grounded in reality. Projects need to be shaped so they can meet financing requirements, but financing also needs to be shaped so it matches what's possible on the ground. If we get that balance right, nature finance can move from ambition to actual deployment, and that's what we need to see. And it's not because every nature project becomes commercial, but because each project is matched with the structure, capital, governance, risk management, and implementation support it actually needs. So I want to briefly connect this framework to actual projects. These are not, abstract examples. They are real situations where structuring questions show up in practice. Just to go through quickly, I know time is getting short, but this project here is a palm sugar supply chain project in Indonesia, built around smallholder farmers using Arenga palm, which grows naturally in the wild and should not be confused with the coconut palm, by the way. It is structured around agroforestry systems with clear benefits for biodiversity, soil health, farmer income, and the business is already producing and exporting. So there is a functioning revenue model that is established around. So the financing question is really now what we need to do is how to scale this. So increasing production, supporting farmers, and expanding into new markets all require additional capital. At this stage, we're working toward, closing both financing and offtake relationships that include engaging buyers while also structuring capital to support growth. The approach combines supply chain financing with elements of blended capital. Commercial capital can support operating businesses and expansion, but grant and catalytic capital is needed around farmers, technical support, and impact delivery. So this becomes a layered structure, one that reflects both commercial supply chain and the broader system behind it. And again, the structure follows the project, not just the presence of revenue, but how that revenue connects to the implementation on the ground. And then on the other project, just to talk about, this is a project, is shade-grown coffee in Laos, developed with a broader agroforestry model that combines coffee with other crops, improving land resilience, reducing soil erosion, and supporting more stable farmer incomes. Here, the value chain is still being developed. The focus is not just on production, but it's building viable systems from the ground up. So the potential for multiple revenue streams, including coffee, other crops, and potentially carbon over time. But at this stage, none of these are financeable on their own. So the first thing that needs to happen is, we need to have better project preparation. So farmer engagement, um, production systems, and a credible route to markets all need to be established. So at this time, or sorry, at the same time, we are working towards structuring early stage financing and offtake partners. So that includes defining the value chain and building a clear pathway to scale. In this case, though, the approach starts with grant-supported preparation combined with early structuring of supply chain relationships. Over time, this can transition into supply chain financing and potentially aggregation across sites. But that sequence matters. So the system is to function before it can scale. So again, the financing follows the project. An earlier stage system requires a different type of capital and a different pathway than a project that is already generating plenty of revenue. So just to close, so just want to leave it at that. And these are examples of I would say different structures and the stage that they're at. So, but the underlying point is consistent. Capital only moves when structure reflects the actual project, its revenue, its risks, and how it's implemented on the ground. So I'll finish there, and we'll begin I believe we'll start with the presentations of the panelists. Let me just stop sharing. So I see my video stopped, but I guess I wasn't needed to be seen. No one wants to see my mug anyway. Okay, so we'll move over to Tom Holland from Vanna. And Tom has been working in the markets for many years, and we've worked together on quite a few things as well. So I just want to hand it over to Tom, and let me just bring up his presentation because he's actually in a situation where he can't do his own slides, so let me help him out here. All right, so
Thanks, John Mark. I think in the interest of time, I'll start talking while you're bringing up the slides.
okay,
So
great.
as John Mark mentioned, we are a nature-based developer. And so the perspective I'll give you is the perspective of a nature-based developer working in Southeast Asia. So I think Will's next. He'll talk about developed markets, ecosystem services, and Max later will be talking about developing countries as well. But he's talking more on the scaled project level. So I'll be talking about projects before they get to scaled level with a specific example about what we're doing in Southeast Asia. So Jean-Marc, if you go to the next slide. Our focus is we are for profit. So we are trying to crowd private capital into community forest restoration. So the problem that we witnessed through operating in the region for decades is forests getting stripped across Southeast Asia. It's a bit different from, let's say, the case of Brazil, where it's very specifically for agriculture and cattle raising in that case. Whereas in our case, say in Myanmar, for example, it's literally just stripping hardwoods and then letting the land and topsoil degrade and wash away. And what these countries have is they have a land tenure called community forests. So these are collective land titles held by villages. And we only work with community forests and help them restore parts of their land, basically, is what we're doing. If you go to the next page, we've been working on this for 7 years. It started off as a CSR project. Philippe, my co-founder, and we founded the largest rural finance MBFI in finance institution in Myanmar. And as a CSR, we started planting trees. We planted about 200,000 trees working with monasteries. We then decided to enhance or evolve what we were doing to crowd in private capital. And I'll talk about the model that we're using next. And over the course of those years, we were asked to consult for Recoft, which is a large forestry NGO, and based in Bangkok. specifically around microfinance in community forests. And so basically, that's how we identified the similar problem in Cambodian community forests, which has about 600 community forests across the country. And so now we're working to scale up the model that we've piloted in Myanmar in Cambodia. Today, we are working in Cambodia. Up to date, we've been awarded grants from TNC, WWF, Scene Coalition, and Japan FA. And in the case of our Cambodia project, we have been working with SDGI and Nomura on developing a carbon program for that. And I'll get to how the economics work in the coming slides. In the next slide, it's just a quick outline as to what we're doing. So our first step over a 10-year program is we plant pioneer species. The role of these pioneers is to restore the soil, put nutrients back in the soil, and provide shade for the polyculture natural forests, which gets planted year 4 once there's enough shade and nutrients back in the soil. And then years 6 to 10, we thin out those pioneer species. Those have a commercial value. So we sell that timber. That's one revenue stream. And in parallel, we develop a carbon program. In an ideal world, most of the commercial sales of the timber go to the investors, where we're targeting to get them mid-teens return. And then we leave a long-term carbon income stream to the community as an incentive to conserve. The community, I should note, also gets paid to do most of the work. So they're getting a livelihood bump from day one, from salaries to do all the work, all the tree planting work, composting, ranger work, etc., as well as that carbon stream. The last slide, just to give a very high level on how, you don't have it here. A very high level about, so, basically in terms of financing, we use equity investment for the year 1, that first phase of pioneers, and a lot of that goes to paying salaries. Year 3, 4, we draw down a debt tranche, and that basically pays for the work around the polyculture planting. And then again, I mentioned how those are paid back. I mean, the equity and debt is mainly paid back by the sale of the sustainable timber. And then there's income streams to the community from the equity and debt, which comes out in the form of salaries, as well as income streams for the community that go into a community trust. And then the equity investors are, again, their equity and debts repaid through the sales of the timber, and then ideally we get grants to re-risk the program. So that's an introduction to what we're doing, and we can talk about some of the challenges we face in the panel discussion. I think with that, we'll go over to Will to talk about TNC and some of the work he's been doing in developed markets ecosystem services. Thank you.
Thanks, Tom, and hi everyone. Hopefully, Tom, can you just give me an indicator? Well, maybe you can't see. Jean-Marc, could you tell me if my slides are showing up okay?
Yes, they are.
Great.
Yeah.
Thank you. All right. Hi everyone. My name is Will McGoldrick. I'm the Regional Managing Director for the Nature Conservancy in the Asia Pacific region. I'm perhaps the odd one out on the phone today. I'm a conservationist by training and less of an investor. But the Nature Conservancy, as a global conservation organization, has known for a long time that if we're serious about delivering conservation at scale, we need to find ways to bring private capital into this space. I think the point's been well made by others already on this call, but we obviously raise a lot of money from philanthropy and from large public grants, and a little bit less, but some from corporate, corporate philanthropy or corporate social responsibility investments. But it's really just the tip of the iceberg of what's needed to deliver the large conservation outcomes that are required. So several years ago, we formed an internal team called NatureVest, which is really focused on leveraging private capital into the conservation space. And to date, as you can see here, we've managed to deploy with partners, so not all on our own, of course, around $4 billion and contributing to some really large scale conservation outcomes across the globe. Nowhere near as much as we should be doing in the Asia Pacific region, actually consistent with the global trend when it comes to investing in nature. The Americas are kind of leading the way in many ways, with some interesting developments, as you can see here, mainly around tourism in the Africa space. But there is one example from the Asia Pacific region which I wanted to focus in on today. And as you can tell from my accent, I'm Australian. That's not the entire reason why I chose this one. I think it is a really interesting example of which has some really important lessons to reflect on during this call. So this is called the Murray-Darling Basin Balanced Water Fund. For those of you who are unfamiliar with Australia, the Murray-Darling Basin is essentially the large agricultural zone of Australia. This is where most of the agricultural production comes from. And it's enabled, that agricultural production is enabled by a series of rivers that form the Murray-Darling river system, basically two large rivers, the Murray River and the Darling River. You can see on the map here where it's located. We had been grappling with a challenge in this river system. It's a highly engineered river system these days. And what that means is that water is designed to be able to get the water from the rivers into the farms as efficiently as possible. And it's no longer designed, or the natural system is no longer allowed to sort of play out as you would hope. In other words, the wetlands are not getting flooded, even in wet years. So they go through many dry years, and historically or over time, this system has evolved to be a sort of boom-bust cycle where you have wet years where the rivers will flood and the wetlands will get flooded, and birds and frogs and other creatures will come back to life. And then in the dry years, it will dry out completely. And that's the normal natural cycle of this system, but it's been broken because of a transition to agriculture. So we were grappling with, how do we do this? How do we get water flowing back into these natural systems? The government has been a major investor in this space. It's bought a large number of water rights back from farmers to take it out of agriculture and put it back to nature, and that's been transformational. But we felt that there was an opportunity also to deploy private capital. And when we put our conservationists together with some finance people, they realized there was an opportunity for what we defined as a counter-cyclical trading model. So this agricultural system actually has a tradable water market. So farmers or anyone can enter this market and buy water and trade water. And the idea is that water will then go to the uses that have the highest economic value. So what we did is we, with partners, formed this fund, and the fund essentially buys water in wet years when it's cheap and abundant, and it sells water in dry years when it's scarce and the price goes up. And that then enables a profit to be formed. The profit, or created, I should say, the profit then flows back to the investors, those who invested in the fund, and a share of the profit is donated to the environment. And that's where we come in, and we pump water that's been donated to the environment, and we literally pump water across the levee banks and spread it into these wetlands, again, to sort of mimic the natural flooding of this system. Initially, it launched at about 22 million Australian dollars. It's now, this slide says 74 million. It's actually, I believe, over 100 million Australian dollars. So it's a great example of how, using an existing market, it was possible to crowd in and bring in private investors and expose them to an impact investing opportunity. It's been getting double-digit returns for those investors, which is also very appealing and has been critical for allowing the model to grow here. I'll just go to the next slide to reflect on some of the lessons. Can I get it to go to the next slide? There we go. First of all, some of the lessons that we took out of this particular example, but also from many of our other investments across the globe, is that familiarity remains very important to investors and to decision makers. So just one anecdote from the Murray-Darling Balanced Water Fund. When we were first building it with our partners, we needed to borrow some money, some debt to help get it off the ground. And when we visited a bank that had made quite strong commitments to invest in the environment space or the conservation space, and we brought this to them, the banker that we were working with basically said, "Oh, this is just totally new. We're not going to be able to be part of it." And it was basically they hadn't done it before, even though the water market in Australia is a very established market. It wasn't something that this particular banker or this bank was familiar with. We were able to overcome that eventually. We were able to sort of tap into higher levels within the bank and to get that support behind it, and eventually the loan was approved, which was great. But it really highlighted to us that going in with something completely new to a large institution can actually be really, really tricky. I see Max smiling there. He may have some familiarity with that problem. It's also really, really important to look for an existing revenue stream. In this case, the revenue coming from the buying and selling of water underpinned by a very large agricultural system where there's existing investment taking place. This has been critical not only for the Murray-Darling Balanced Water Fund, but for all of our investments. It's very hard to go in and do something when there's not an existing revenue stream. If you've got to build a completely new revenue stream, it's very hard, and it takes you're starting from behind the eight ball. Don't underestimate the returns first reality. This also has been critical. There are many more people out there who claim to be impact investors than people who are actually doing impact investing. And what I mean by that is when it comes to actually writing the check or getting involved in a fund, they really zone in on returns. Despite the impact being really critical, returns are often much more important when it comes to making that investment. The ecological timescales are often very different to market expectations. In a recent report that we published with Forest Trends, this was highlighted as well. When you're talking about, similar to what Tom was talking about, quite long timescales to get the ecological outcomes that underpin the investment, that often doesn't marry up with what people who are investing in funds would normally be used to over a sort of 3 to 5 year time frame. We're talking sort of 5 to 10 year time frame, or even much longer when it comes to carbon projects, for example. Policy and regulatory frameworks are really, really important. As I said before, in Australia, we have an existing market for the trade of water in the Murray-Darling Basin. That's underpinned by a very significant and multi-decade policy framework. It's not without its challenges. It is a contested policy space. And it's been very, very politicized over the years. So that creates uncertainty. But if you shift into other countries or other places where we're trying to do investments, the lack of clear policy signals or the lack of a stable regulatory framework can be a real barrier. And just another little anecdote from this particular fund, it was able to get off the ground largely in the early years because of a significant philanthropic contribution from an Australian who was living in the United States. And I think, if I have this right, he made about $1 million gift to help get this off the ground. That's then now translated into a roughly $100 million fund. So it's a very large kind of sort of payback in a sense, although his was not paid back as a purely philanthropic investment, but it does highlight the importance of some of that early catalytic capital to get these sort of things off the ground. I'll pause there. I know we're sort of running a little bit behind time, and I know we want to get to some of the other speakers. So I think I'm handing straight over to Max. Is that right, Shoma?
Yeah, that's correct. Yeah, absolutely.
Yeah.
So go ahead. So Max Thomas from HSBC.
Fantastic. Thanks very much, Jean-Marc, and thanks so much, William. I fully agree with some of those challenges that William shared there. So for those of you on the call, so I'm Max Thomas. I sit within what we call our sustainable capital markets team. So this is a team that focuses primarily what you'd think of as kind of the green bond products. But also we try and do structures a little bit more fun, a little bit more interesting, and kind of around certain themes and certain topics. So I think I'm here to provide kind of the facilitator's view that Kimura-san kind of highlighted earlier. And I think it's very interesting kind of hear how these themes are kind of feeding throughout. So I think as Jean-Marc kind of highlighted, there's a number of tools and instruments available. Blended finance is kind of often promoted, kind of lots of song and dance around it, lots of focus on it, but actually finding the concessionary capital within it is a challenge, finding the right outcomes, right levers when you get down to kind of the boots on the ground. The actual metrics people are looking for tend to be primarily financial, and maybe they're willing to forfeit a portion, but definitely they want a financial return. Blue, green finance kind of continues to be a topic of discussion, and there's kind of certain nature-based elements within that. And then I think the other piece that Jean-Marc kind of touched on there is insurance. This is definitely an underutilized part of the market. I think when we sit here as a credit analyst, or when we look at kind of a transaction from the lens of will I get paid back and can I understand the risks, we have to be relatively candid as a bank. We're not that good at measuring these risks. The ones that are really good at measuring kind of more nature and kind of physical impact risks are the insurance companies. So actually, from my mind, much of this is kind of how do we work across different parts of the financial world, kind of to pull structures together and make sure we kind of bring something that is actually meaningful for the market. So I really like that phrase. Right solutions is the right project, right stage, and the right structure. Then we'll get the right solution. But actually, we need all those pieces to come together within the jigsaw to kind of bring that to the market. And hopefully, I can provide a little bit more from the at scale perspective. So here's an example of something that we've kind of been working on within the bank, and I apologize for kind of confidentiality reasons. We have to remove client names from this, but this is much aligned with some structures that you may well have heard of called outcome bond structures. So these are in a product that have been developed for a little while, primarily driven by IFC or World Bank, but I know a number of banks are working extensively on these. But fundamentally, it's kind of investing in these smaller scale, harder to quantify the financial return projects and actually driving capital towards them. So I will talk at kind of relatively high level about what we're trying to do here, but I think the key to my mind is to be open-minded about the structure. This is something that has worked, but actually the pieces of the jigsaw, to go back to that analogy, are relatively flexible. So what we're trying to do here is leverage a highly rated corporate or MDB who has strong access to financing, has strong access to capital, and then how do we leverage that name and that credit to support funding into projects, and how do we share the risk within that? So I think what we have on the page here, if we look at, we start at point one. So here we would have, as I mentioned, a highly rated credit, a highly rated kind of corporate bond issuer who's very well known in the market, has a strong funding profile and investors are very comfortable with them, but also has a perspective around driving impact and driving positive sustainability outcomes. It can be a government, it can be a multilateral development bank, it could be a corporate. There are many different examples of who this could be. They then issue a bond, and this is where it gets a little bit complicated. So they issue a bond. The investors, rather than being guaranteed a flat coupon through the life of the bond, they instead receive a variable coupon. So then this kind of worked example here. Traditionally, the investors would receive a coupon in line with the long gray line, so about 4.5%. But instead, in this transaction, they're promised 1.75%. So they take a reduction in coupon. So they don't get nothing, but there's no guarantee that they get a good return, and they're definitely potentially forfeiting some return. In return for that forfeited return, the money is upfronted. So you take the net present value of the coupons over the life of the bond, and then they are lent to a carbon developer. So that goes from 1 to 2. to the green leaf, and now we're at the carbon developer. So this carbon developer has access to lower cost of capital because they're leveraging the funds that the highly rated issuer raised cost of funding at. And then they are able to utilize that to invest into their project for project development. The core piece here is that within this project that we're developing, there is an off-taker. In the example here, we have a carbon credit project. So we have the carbon credit project developer has a project that they have in scope. It is a reforestation project, and they have an off-taker to buy the credits once that reforestation starts to come online. So as you can see, in stage 3, once the carbon removal units come to fruition, they are sold to the off-taker. The pre-identified buyer, the contractualized buyer, pays for them and then returns the cash ultimately back to the investors. And that's the gray box we see here. So you can see you have your red boxes along the bottom, which is the interest paid by the high credit quality issuer. The gray boxes are the return from the carbon credit buyer, and he effectively repays the forfeited coupons that the other or that the investors gave up upfront. So the reason that investors would consider this and they would look at it is there is an economic pickup here. So the key challenge that the carbon credit project developer has is their cost of funding is exceptionally high. So through these types of structures, you're able to lend to them at a significantly lower cost of funding, but you structure it such that if all the carbon credits are sold and you build in a lot of safeguards around these transactions, then actually they'll deliver a pickup versus the traditional coupon yield. So in this worked example, so the maximum yield of kind of 4.35% is about 40 basis points more than what the investor would normally receive from this type of credit. So a 10% pickup in yield for the same quality credit, yes, there is capital at risk, but equally you are driving investments into an additive project with clear nature benefits. It means that the investors have significant safeguards around where their money is going. They know and they're able to quantify the return on investment. And there may be some shortfall in funding, but the structure is designed such that they have relative security that they should get repaid on this transaction. One of the key challenges that we see this type of deal is actually on the purchase of the carbon credits. And maybe I'll hold my hands up here. This is some bankers being short-sighted. We have focused very much on projects where there is a clear offtake of a high quality credit, and we are relatively stringent on what we're willing to do there. But actually, when we speak to investors, this works for various different outcomes, not just carbon credits. We've seen transactions supporting rhino populations. We have been working on transactions whereby you're looking at a certain crop productivity level. There are various different structures and various different examples that even my counterparts on the call have highlighted today that could easily be utilized as potential outcomes. As long as you can monetize them, as long as you can find someone to pay for them, then absolutely you can incorporate them into these structures. So this is one kind of worked example. We call it at scale, but actually the funding need, because you're leveraging just the coupon, we can go down to kind of financings of as little as, excuse my flippancy there, kind of 40 million US dollars. So it's still a relatively large check size, but it does reduce the kind of need to raise a benchmark size bond, which otherwise would preclude a lot of issuers from accessing this market. Jean-Marc, I think that's all from my side here, and hopefully that can wrap us and move us to Q&A quickly.
Excellent. Yeah. Max, thanks a lot for that. That was an excellent articulation.